Now, intraday volatility, that means you're going to be looking for an hourly or basically a 60-minute swing high or a swing low that is likely to move to. It's in close proximity to it. It's been going up for the last couple hours or so. And it's just getting real close to an obvious 60-minute high. If it's not doing that, go down to a 15-minute time frame. Look for a swing high it might be gravitating to. If it's gravitating towards that 15-minute high, and real important, here's the filter, folks. Okay, this is the fucking part that you're not gonna do. And when you fucking lose, you're gonna swear up and down that it fucking fails. On a 1 or 5 minute chart, if you're bullish, it must show a swing low taken and then reject and go higher. Whatever time frame, whether it be the 1 minute or 5 minute, whatever time frame that swing low is breached, it goes below it. It only needs to go by one tick. Doesn't need to close below it either. It just needs to go below it. That time frame that has the swing low, it must have a candle close up after it takes that low. Once it does that, you immediately drop down to a 30-second chart. But I can't have a 30-second chart. Then you can't fucking trade this model. Just apply it to a higher time frame. Instead of a 30-second, use the 1 minute and use the 15-minute and 1 hour chart. Everything's scalable. But I'm giving you something that you can test a lot. There's lots of examples doing this throughout the week, from the beginning of trading on Sunday to Friday's close. There's many instances of you going in and going to be able to back test this and have no bias. And you're going to have losing trades. It's okay. But you have to have whatever that time frame is, the 1 minute or the 5 minute, there has to be a stop run. One of the first primary principles I taught when I stepped out on baby pips is the real move will not happen. The dynamic price runs where there's magnitude and delivery and speed, that will happen after a pool of liquidity is engaged. That means if the market's bullish, if you think it's going to go higher, I think it's going to draw up to some level, whether it be a high, a relative equal high, inefficiency above market price, whatever that is up there, that you're framing as a reason for it to want to go up, it's far more likely to get up there with conviction and speed if there has been a short-term run on liquidity that's below the marketplace in the form of stops or sell-side liquidity. Because the market's going to go down to allow traders to buy those stops. What traders? Smart money. The algorithm is cowtailing to them. It's called handshaking. The market reprices to levels to allow handshaking to occur. That's the real term. That's exactly what's going on. And when those orders are being provided to the participants that are on the sideline, you're not seeing their fucking orders on the DOM, the depth of market. It's not DOM, by the way. DOM. When that is showing those numbers and stuff, their orders are not sitting there. Smart money's orders are not sitting there. They're not fucking sitting there, folks. That's why I'm laughing at you when you're fucking using it and you're asking me, show me your order book, show me your level 2 data. That's fucking bullshit. That's all bullshit. It's spoofing. Their orders are immediately piped in. Immediately. They're not sitting around waiting for you can read them. If they have their orders the size of their fucking orders and the volume of their fucking orders, if they were sitting out there where you could see them, you could really read sentiment then. They're never going to fucking let you do that. Why the fuck is it so hard for you not to see this? Because people on CNBC and people that are allowed to talk on CNBC that have no fucking real clout on Twitter. I've been on CNBC, so therefore my opinion matters. The fuck out of here. When it drops down to take the sell side when you're bullish, whatever that time frame is that has the swing low that it pierces and goes below, as soon as it does that, you have to wait for one candle to be up close. Once it does that, then and only then do you drop down to the 30-second chart and you wait for a fair value gap to form and then you buy. The best one is the first, but you can take continuous buys on a 30-second every time it creates a fair value gap or trades to a down closed candle, you treat it like a bullish order block. And you can turn that single one contract model over time. If you submit the 3 months of doing it, you build discipline and you aim for that liquidity.